Good morning. I'm CA SILPA RAMDAS and I'm a member of the Thrissur branch of SARCF ICAI. I'm here today to share some thoughts on Section 194N of the Income Tax Act 1961. As all of us know, Section 194N was introduced by Union Budget 2019 and was further amended by Clause 84 of Union Budget 2020. Let's move on to see the implications of Section 194N. What is the purpose for which Section 194N was introduced? Section 194N speaks about TDS on payment of certain amounts in cash. So, by a plain reading itself, we can understand that Section 194N was introduced to discourage cash transactions in the country and to promote digital economy. As all of us are experiencing now, digital economy has become the rule of the day because our freedom of movement is restricted nowadays and we have to depend on digital transactions, and Section 194N is such a section which has been introduced to encourage digital transactions in our country. What is the effective date from which Section 194N is applicable? As I previously said, it was inserted with effect from 1st of September 2019, but it was amended by Union Budget 2020 with further changes, and the amended provisions is effective from 1st of July 2020. Now let's see on what Section 194N will apply. Section 194N specifically applies only on cash withdrawals. Its applicability is limited to withdrawal of amounts in cash. And what is the limit of Section 194N? Section 194N applies to cash withdrawals above rupees 1 crore, that is in a period of one financial year. Moving on to the definition of Section 194N, let's break the section definition into different legs and try to understand. This section applies to sums of money or aggregate of sums. That is, it can be a single withdrawal of rupees 1 crore and above, or it can be withdrawals made over a period of time amounting to rupees 1 crore or above. That is in a specific period, the certain period which the section says. Then the withdrawal has to be in cash, withdrawn in cash by a recipient. That is, the section applies on the recipient of money. The tax is being deducted from the recipient's amount. And the period has been reckoned to be a financial year. A financial year is from April to March. That is, this section applies to sums of money or aggregate sums withdrawn in cash by a recipient in a specific financial year. Then let's see the applicability of this section and who all are the persons who will come under the ambit of Section 194N. Firstly, Section 194N is applicable on an individual, then a Hindu undivided family, a partnership firm or a LLP, local authority, a company, an association of persons, or a body of individuals. So we can understand that almost on all kinds of persons, taxable persons, Section 194N is applicable. Now let's see who are the persons responsible to deduct tax under Section 194N. Who all should, who are the payers should deduct tax under Section 194N. First, a banking company, let it be a private bank or a public sector bank, they have to deduct tax when they are paying cash to an individual or any other person in cash above rupees 1 crore. Second is a cooperative society engaged in the business of banking. A cooperative bank is liable to deduct tax under Section 194N. The third is a post office responsible for paying any sum or aggregate of sums from one or more accounts. That is, a person might be having an SB account or an RD account with the post office. So the section says that if the cash payment in one or more accounts is more than rupees 1 crore, to the recipient, then post office is responsible to deduct tax under section 194. What is the point of deduction of tax under section 194N? Let's understand that. Tax is to be deducted at the time of making the payment in cash to the recipient. So whenever the cash payment is made to the recipient, at that point of time, tax has to be deducted. When the recipient withdraws certain sums of money at regular intervals, the payer will have to deduct TDS once the total sum withdrawn exceeds rupees 1 crore. That is, whenever the withdrawals are exceeding rupees 1 crore, the TDS has to be made by the payer. Let's understand it through an example. Imagine a person withdraws rupees 99 lakhs up to February in a financial year from his bank account, and in March he is making another withdrawal of rupees 1,50,000 from his account. Now, section 194N will be attracted and TDS will be deducted from rupees 50,000, that is the amount over and above rupees 1 crore, rupees 50,000, and TDS has to be deducted and paid on rupees 50,000. For the purpose of determining the rate of TDS, the SSEs, the taxpayers, have been divided into two categories by Amendment Act 2020, that is, persons who have not filed their returns of income for the last 3 assessment years and persons who have filed their returns of income for the last 3 assessment years. Let's see what happens if a person who has not filed his returns of income for the last 3 assessment years withdraws cash above rupees 1 crore from a payer. In the case of a recipient who has not filed the returns of income for all the 3 assessment years relevant to the 3 previous years for which the time limit to file return under section 139(1) has expired, the limit is not rupees 1 crore, the limit is 20 lakhs. And that is the amendment which was brought about by Union Budget 2020. The limit is 20 lakhs, and for every withdrawal above 20 lakhs up to 1 crores, tax will be deducted at the rate of 2%. What about withdrawals above rupees 1 crore? Above rupees 1 crore, for every withdrawal, tax will be deducted at the rate of 5% from him. This is applicable to persons who have not filed their returns of income for all the 3 assessment years relevant to the previous year, for which the time limit to file return under section 139(1) has expired, as I said earlier. In the case of recipient who has filed the returns of income for all the 3 assessment years relevant to the 3 previous years, that is a regular taxpayer, a regular return filer, what will be his condition? His limit will be 1 crore of rupees, that is for 20 lakhs to 1 crore withdrawal, he will not have to pay any TDS, but from 1 crore onwards, his cash withdrawals above rupees 1 crore will be exigible to 2% of TDS under section 194N. So far, we discussed about section 194N, its definition, the rate of TDS, applicability, etc. Now let's go to the non-applicability of section 194N. On what all section 194N will not apply? Let's see. Where any payment is made to the government, any banking company including a cooperative bank, post office, any business correspondent of a banking company including cooperative bank, any white label ATM operator of a banking company or a cooperative bank, any other person as notified by the central government in the official gazette. So for 6 categories of payments, section 194N will not apply, and all these 6 persons have to be on the recipient side for 194N not to apply to that payment. Now let's illustrate the provisions of section 194N through a small illustration. We have Mr. A and Mr. B. Mr. A, who has filed his income tax returns for all the 3 assessment years, and Mr. B, who has not at all filed any income tax returns, not even for 3 assessment years, even before he has not filed. Let's see what is the situation. In the case of Mr. A, when he is making withdrawals, cash withdrawals above rupees 20 lakhs up to rupees 1 crore, he will not have to pay any TDS, that is, his TDS will be made at nil rate of tax, and his withdrawals, cash withdrawals above rupees 1 crore will be taxable at the rate of 2% under section 194N. And in the case of Mr. B, if he is making, Mr. B, as you know, he has not filed his returns of income for the last 3 assessment years, and he is making a withdrawal of rupees 20 lakhs and above, that is 20 lakhs up to rupees 1 crore. If he is making cash withdrawals, the TDS on him, on the withdrawals made by him, will be 2% of the amount withdrawn over and above rupees 20 lakhs, and above rupees 1 crore, his TDS rate will be 5% on the amount withdrawn in cash. Hope this illustration gives a clear understanding of Section 194N. Section 198 of the Income Tax Act states that tax deducted is income received. Any tax deducted as per provisions of Chapter 17B from Sections 192 to 196D shall be deemed to be income received by the assessee and shall be included in computing his income. But the second proviso to Section 198 states that the sum deducted in accordance with the provisions of Section 194N shall not be deemed to be income received for the purpose of computing the income of the assessee. It means that the tax deducted in accordance with 194N shall not be aggregated with the income of the assessee in computing his total income if in any year he has TDS under Section 194N. As in any other payments, Section 206AA is equally applicable to transactions under Section 194N. We all know that Section 206AA speaks about consequences if PAN is not submitted by the recipient to the payer. Let's see in Section 194N what happens if PAN is not submitted to the payer. The TDS to be deducted is at an enhanced rate of 20% and the limit is only rupees 20 lakhs. That is, from withdrawal of rupees 20 lakhs onwards, tax will be deducted under Section 194N at the rate of 20% if PAN is not submitted by the recipient to the payer. I think I have given a detailed explanation about the provisions of Section 194N, and I thank you for your patient hearing.